Is the party over?
Well, if you look at the first half, we had 108 new listings. So while that's a dramatic fall off from last year, if you go back historically, that was actually a pretty good number of new listings for us. And by the way, that's compared to 12 on the New York Stock Exchange. So we had about an 88% win rate in the first half. What really fell off a cliff was the capital raise. So we only saw $12 billion raised in the first half of last year. And so that was a fraction of what we saw last year and what we see in a typical year. So still seeing a number of new listings, but not a lot of big listings.
At one point, it was very much felt like a SPAC party in 2020, 2021. Is that gone, the special purpose acquisition companies?
So of the 108 IPOs we had in the first half, 59 were SPAC IPOs. And so you did still see new sponsors coming to market. There has been a slowdown in that market compared to what we saw last year, based on kind of the market reception on some of the recent SPAC business combinations, as well as some proposed new rules from the SEC. However, we did also see 31 SPAC business combinations get completed in the first half of this year. So it's still a viable way for companies to come to market, but definitely under a little bit more scrutiny.
Certainly, and we've heard sort of theorized the likes of Instacart, the likes of Discord, who've made it known that they want to go public. How are they now assessing the market? What does the backlog look like?
I think there's an enormous backlog of companies that we've been working with since, some of which last year, right? So if a company went on file confidentially in December of 2021, it typically takes 2 to 3 months to work through the SEC comment process. By the time they got to the end of that process, they were really not going to go into the market as choppy as it was in Q2. So I think everybody's looking for a little bit more stability in the market. They want to see the volatility index or the VIX come back down below 25 or 20 even. And they want to see some of the macro uncertainty get flushed out of the market in terms of what's the Fed doing on rate hikes, the entire geopolitical situation. So we're hopeful we're going to see some big deals start to come back to market after Labor Day, but it's still a bit uncertain.
Talk to us about, therefore, how private companies can help their employee base by having some sort of secondary offering, or how we can have liquidity events for these businesses, many of which have got talent that they need to keep incentivized. I know that you were president of Liquidity Solutions before. You talked about, you know, when you're in the private market, how you can have these sorts of events. What are people looking at?
That's right. So Nasdaq private market is still a very viable alternative as long as the private capital markets hold up. We still see a lot of capital available in the private markets, although we are starting to see valuations come down in the private markets to follow along with the public markets. And so whether companies are going to do a tender offer out to give a broad-based liquidity for their employees, whether they want to run an auction to do some price discovery and see what's the true value of their common stock now, or just do one-off block sales for some of the founders and early execs, Nasdaq private market has a great platform to help companies achieve that liquidity while they're waiting a little bit longer for the IPO.
How many of those companies actually want to lock in those sorts of new valuations, though? Because some of them are eye-watering when we're looking at the reports about Klarna, for example.
Well, I think, you know, if you look at it, there's a lot of companies on the public side whose valuations have been compressed. And so it makes sense that companies on the private side would see a similar compression, especially those in a similar sector. And so one of the things we track really closely is the price to earnings multiple in the public markets relative to the 10-year interest rate. And there's a pretty clear trend over time that as that 10-year interest rate goes up, PE multiples come down because those future cash flows, or lack thereof, are a little bit less valuable in a high interest rate environment.
Who are some of the pools of money who are still willing to commit to this private market at the moment, or indeed to new recent IPOs? We've heard of certain institutions looking to actually help bridge that gap when companies are unable to raise new funding rounds or indeed go to the public markets.
That's right. I think a lot of folks will look to step in. The question a lot of companies are asking about is, should I raise that new round at equity where I have to price the round, or is it better to do some type of a convertible debt security where I can bridge the round without having to price that? Part of this is the psychology of the founders and CEOs out there. You know, they just raised a round of funding last year. They probably announced that very proudly to their employees. And now they're probably reticent to go out and announce a new lower round valuation, even though that's probably where the market would clear. So that trade-off between debt and equity is something we hear a lot of companies talking about.
And what about where companies are coming from? Are they all US domestic based? Of course, there used to be that time where lots of Chinese based companies wanted to list in the US. Has that sort of fallen afoul as well?
Well, we definitely have seen some headwinds in terms of recruiting international listings. along with a lot of the geopolitical uncertainty. There's been a lot of nationalism in the search for new listings. So while things have slowed down a bit with the Chinese listings, while we've been working through some of the accounting issues that the SEC is working with their regulators on, we have seen an increase in demand from companies in Southeast Asia, Latin America, and other emerging markets. So for US investors, we think it's critical that we keep attracting these high growth companies from emerging markets to the US capital markets. So we're hard at work on that.
Mm-hmm. And what about the innovation on your side? What more are you looking to do at the moment in terms of ensuring that they keep on coming to Nasdaq? As you say, you've got a big win rate. How are you looking to ensure you're busy if indeed the pool of companies wanting to come to market is a little bit smaller?
Well, we always like to say we have solutions for companies at every stage of their life cycle. So we talked a little bit about how Nasdaq Private Market can help with liquidity pre-IPO. Once you're a public company, an issue that's getting more and more important is what are you doing around your ESG disclosures? Mm-hmm. The SEC has proposed some rules around climate disclosure. So we're actively working with our issuers to advocate on their behalf with the SEC to make sure that those new regulations are reasonable. And at the same time, we're looking into what are the commercially viable options for us to help our companies with these new reporting requirements from regulators, investors, and all of their stakeholders. So we recently completed the acquisition of Metrio, an ESG KPI reporting platform that's going to help companies accelerate the way that they report their non-financial metrics.
And let's just talk a little bit. When you think of ESG, I immediately started to think of the moves that Nasdaq was making, ensuring that, well, the S was uplifted as well, not just environmental, but thinking about diversity on boards and who you have on and listing. How is that conversation going? How much are investors, sort of, to be blunt, caring about that at the moment?
Well, I think one of the hallmarks of a great market is to have great corporate governance standards, and that's why we did introduce a new disclosure rule around board diversity. We think it's a critical part for investors to be informed about the diversity of companies' boards. And so we've seen a great response from that in terms of both companies and investors. And as you mentioned on the S, there is a lot of work that's going into, especially around human capital management within the issuers and how they're thinking about their employee base, especially during this challenging time.